A good credit score isn't one number, it's whether you clear the right thresholds. Most credit score myths come from treating credit like a single yes or no grade. There isn't one magic number that means approved, and not everyone even uses the same score model. A good score also doesn't work everywhere, because lenders set their own cutoffs and rules. A lower score doesn't mean you're banned from credit, but it does shrink your options and raise costs. And one late payment isn't minor. Timing, reporting, and patterns matter. Paying early helps, but it doesn't erase past marks. A good or bad score starts with knowing the scale lenders are pricing you on. The most common model is FICO, which runs from 3s to 850, and lenders often talk about 5 broad bands rather than one perfect target. Many consider 740 and up a strong upper bucket, but the big split is usually prime versus subprime, meaning lower risk versus higher risk. That risk shows up in pricing, mainly APR and fees, not just approvals. And even if you're in a good band, approval still isn't guaranteed. Your score moves based on a few weighted levers, and the biggest ones are predictable. Payment history is about 35% of a FICO score, so missed payments hurt more than almost anything. Utilization, how much of your credit limit you're using, is about 30, and it's heavily affected by what gets reported on your statement date, not your due date. Credit age is about 15%, so older accounts help over time. New credit is about 10%, because many applications can signal risk. Credit mix is about 10, and it's usually the smallest lever for most people. A good score should be defined by your goal, because thresholds beat bragging rights. If you're trying to qualify for a specific card or a lower loan APR, clearing that lender's cutoff matters more than chasing a round number. Also, APR isn't one universal rate. Lenders price you based on your tier and your full credit report, not just the score. In the short term, utilization is the dial that moves fastest, while other factors take months or years. One practical move is asking for a credit limit increase, because a higher limit can lower utilization without changing your spending. If you want a stronger score, focus on habits that protect the high-impact factors. Set autopay for at least the minimum so you don't risk a 30-day late mark. If utilization is your issue, pay before the statement closes, because that's typically when the balance gets reported. A simple target is keeping utilization under 10%, especially if you're applying soon. You can also request a limit increase to create more breathing room. Space out new applications to avoid clustering hard inquiries, and review your credit reports for errors that can unfairly drag you down. Payment history is about 35% of your FICO score, and utilization is about 30%. Those two levers do most of the work. If you want to find a card that fits your score range and how you actually spend, CreditCardAgent matches you and shows the estimated dollar impact versus your current card. Free, about 3 minutes, no credit check. Links in the description.